The market is selling off yet again on tariff news. Let's talk all about it in today's video. So we've got some interesting stuff to discuss. First of all, we have an additional 10% on Chinese imports expected to hit markets alongside Canada and Mexico tariffs do seem to be going forward, according to Trump. March 4th. I mean, this is interesting stuff. Stuff is heating up in markets, and we do see a pretty risk-off reaction that we're going to discuss in today's video. We also heard recently, yesterday actually, 25% expected tariffs on the EU, which is a major car manufacturer and seller to the United States. We love our BMWs and Volkswagens over here, but this really imposes some serious risk to this market. I want to talk all about it. And finally, we did hear on the UK, Trump just wants reciprocal tariffs. This seems to be a theme that he keeps pointing out. He wants equal tariffs. You know, when we send a good to another country or import a good from a country, Trump is pretty adamant about getting those tariffs to be evenly distributed in both directions. This, alongside the efforts of Elon Musk and the DOGE, the Department of Government Efficiency, is seriously causing some hiccups in the market, and we're going to break all of it down in today's video. As we get started, if you could do me a huge favor, hit the thumbs up button, subscribe, and leave your politics at the door, because I'm not here to try and rile people up. I'm here to try and cover what's happening in markets, why this could continue to cause market volatility, and what specific charts are most poised to suffer or benefit from this situation. Here's a 15-minute chart of the S&P 500, and you can see a pretty consistent theme. We are seeing pretty good kind of sell-offs, followed by these brief pullbacks, and then sell-offs once more, with another one kind of hitting the floor here today. So what's going on with all of this, and why does this cause the stock market to panic sell every time there is some mention of tariff? Well, here's the reason. The idea is basically disruption of trade can really substantially stunt a business's activities. Let's say, for example, you are Ford Motor Company and you do a lot of manufacturing in Mexico, but there's going to be this huge tariff that gets imposed, and it really screws up your profit margins. That business may have to lay off a ton of people. They may see profit margins kind of deteriorate, and so they have to rapidly pull their business back to America to avoid the tariff, which in its idea is actually not a bad idea. I think any country wants more business and industry to come locally. The debate, the controversy between, different sides of the aisle and economists is whether or not this should be happening as fast as it currently is happening, or if this kind of speedy action is a required kind of component, or short-term pain for long-term gain. Whether you fall on either side doesn't really matter. From a trading perspective, let's talk about why short-term that has the market freaking out. Well, again, it disrupts some of the business activities of key players in the economy, and sentiment about the forward-looking economy is not looking so good. In fact, the other day, somebody commented on my channel. They said, "Nick, why do you look at economic data every day? You just need to be making a video every week or two, and you don't need to be covering economic data so much." Honestly, this is what we do on the channel. We talk macro, we talk economic data, and I will not stop showing it and talking about it every single day. It's what moves the markets. Clearly today, moving big time off of tariff concerns. And with tariff concerns, part of the concern that we've been seeing has been a slope in consumer sentiment, and we've also seen some missed expectations across the board. That being said, today's preliminary GDP numbers did meet up to expectations, 2.3. So at least it wasn't a 2.2% reading with preliminary GDP. We met expectations, so that's at least better than where it was, I would say. But at the same time, we still have a miss in PMI numbers for the services component. Retail sales are still really down, and we have high inflation that seems to not be going away anytime soon. So, there are problems underlying in this economy. Could it all smoothen out and we have, a good couple years after this? Maybe. But right now, in the short run, and this is what markets focus on, we're seeing some problematic kind of indicators showing there may be some growth concerns in this market. The stock market, the S&P 500, is hitting a key level of support around 5,925. Let's see if we can get some sort of more material bounce going, but we've been here for a couple days, and each time we come into this area, buyers are strong. We have to give them that. But if you get some sort of closure underneath this level, I would be a little bit cautious and think that we actually could head lower down to like 5850 on the S&P. Personally, I don't have any positions in the S&P 500, and when it comes to equities in general or indices, I'm just a bit cautious. I would not say that I'm bearish on this environment, but I would not be surprised at all as we kind of digest all this tariff and this period that we're in, that we could totally see further downside in the short run. But in the long term, I do still think that the stock market and the economy looks like it's in a pretty good spot. Now, the economy itself is not in a bad spot. Right? Somebody asked me on my video the other day, in fact, maybe we can find that comment, Chandler, you could throw it up on the screen. Somebody asked me, specifically, why is the stock market going up if the economy is so bad? And the economy is not bad for the United States. It's actually quite good. It's just maybe not as growth heavy. Maybe we're seeing a little bit of a slowdown in growth. There is a difference between saying we're in a terrible economy versus we were in this phenomenal looking economy and now things are starting to materially slow down just a bit. And with that slowdown, I do think it's appropriate that we see a normalization in the valuations of companies. And that's why I think that, I'm not a bear, but I do still think that there is room for the market to short term come down. When I say when I'm not a bear, I mean, maybe I am a little bit more bearish on the short term, but in the long term, I'm still very much bullish on US equities. By the way, if you haven't entered our free to join Edge Finder giveaway, you can currently do so completely free in our Telegram channel, which is linked in the description down below. Pull up the Telegram channel and just make sure you enter your name in for a chance to win a free copy, and we will send you all the information and updates about who wins that Edge Finder giveaway. We did this last week. We decided to run it back one more time. So if you'd like to enter the giveaway, click the link in the description to join the Telegram, then you can drop your name in the hat. Metals are also pulling back here recently, seeing a little bit of a sell event happening right now. We see gold actually hitting this key level of support. I'm going to watch this pullback pretty close, and if I can find the right entry, I may choose to get long on gold. And if I do take that position, it will be notified inside of our Discord VIP room, which is linked in the description down below. You can see all trades and updates inside of our Discord if you are an existing member there with us. I'd like to see if we can hold this area of support, but fundamentally, I do still like gold to the upside. We can see gold is still getting a bullish reading on the Edge Finder, but noticeably silver has actually lost its bullish reading here. So I am not going to ignore that, though I don't close positions that I currently have open just because we go from bullish to neutral. I do still look at price action to kind of decide if I want to stay in the trade or not. What's actually costing some score here, as you can see, the trend score for silver has flipped bearish. So price action is kind of gone against us here. And so what that means for me, since I have a silver position, is I'm just going to manage it. And if we do break through support completely here, that's going to be my signal to abandon this trade idea and call it quits. But I still want to give this a chance. I liked the entry. I still like the fundamental backdrop for silver. But again, when it comes to my system, I enter based on kind of the macro environment that we're in. And then if it doesn't work, right, if we completely drop for silver, I'll stop out and let that be my deciding factor of closing the trade or not. Yen pairs continue to get a very bearish reading across the board here on the Edge Finder. This is something I've been paying close attention to, and I remain short CHF JPY, the Swiss franc against the yen. I've had some questions about why specifically I like the idea of shorting Swiss yen and not something like dollar yen or pound yen, which are very popular currency pairs. Why Swiss yen? Well, I have a short position on the Swiss yen because, as I just showed you in the Edge Finder's overall view of the yen, it's pretty bullish on yen. So if I want to be bullish yen, what are my options? As a trader, you've got to know what the trading costs associated to a trade might be. And if you are to short dollar yen, what we're looking at is the carry trade scanner within the Edge Finder, which can be found, it's towards the bottom here. Let me just show you, I'll move my camera. You can see the carry trade scanner can be accessed here on your left-hand navigation bar. And what we can see here is that the Swiss yen specifically has a pretty close interest rate between the two countries, Switzerland and Japan. And this is important because when you trade a high yielding currency versus a low yielding currency to the short side, it can be very expensive if you take the opposite direction to the carry trade. So specifically, if I short dollar yen, and some of you may have noticed this before, if you hold that overnight, it is very expensive to hold overnight. But look at the difference between these two. You can actually see that there is no interest rate divergence. They are completely the same, right? So that same offering actually allows for a more a more cost-efficient way to gain yen bullish exposure without paying a whole bunch in carry trade swaps. If you're not a Forex trader, please feel free to skip this part of the video, but carry trade is something really important to my FX viewers. And so when I wanted to get long the yen, I specifically looked for Swiss yen because of the low cost to short this currency pair and gain long exposure to the Japanese yen. Remember, you are shorting Swiss franc and buying Japanese yen. Like I said, you can access the carry trade scanner within the Edge Finder, and this does of course apply to all currencies. We have a ton of different listed items here. You can check this for yourself if you're somebody who likes to take advantage of the carry trade. Currency pairs like Euro US dollar and the pound against the US dollar are seeing big slides to the downside today following some of that tariff news. We do see, like I said, the Euro dollar big slide. And if we take a look at the daily chart on this one, you can see big resistance was hit and now seems to be following through to the downside. I know Ivan from our group is currently short this one. So shout out Ivan. That's awesome that you caught that trade. We'll see if we can actually see a larger move here. The other one is Forex James. He's also short Euro dollar. Seems like we've got some EU bears in the community, but we'll see if there is some follow through. You know, longer term, the euro has been in a really strong downward trend. We've been chopping range bound, but perhaps with all this tariff news, this could cause some downside for the European region. Now, here's the thing: is with tariffs between EU and US, what you run into is, you know, we love our European cars. And that's a major portion of the European economy is selling cars to America. And so if there is a 25% tax added on to that cost of cars, it could really hurt the demand for European cars and hence hurt the European economy. And let's face it, when we look at the EU economic heat map, Europe does not need any more hurt in their economy. With just 0.1% GDP growth, it's not a very exciting market. It's not a super innovative or you know, market leading part of the world at this time. And you know, that divergence even further with price accessibility to the American consumer could be problematic for the story for Europe. And it's definitely a little bit of a bleak concept there. The DAX, however, has been in a very strong upward trend. Let's see how the DAX is doing here today. You can see it's pulling back a little bit on this news following this morning's kind of tariff announcement or yesterday's tariff announcement with the EU. So we'll see what happens there, but it is quite a volatile time across markets. And you know, also we can take a look at China's market as well. Didn't really do too much damage. This thing has been in a really strong upward trend here, but the increased tariffs on China this morning as well announced could be really interesting. And Nvidia is down here today following their earnings yesterday. It did kind of hold up the market a little bit yesterday with the initial pop, but with some follow through to the downside, as well as the China announcements here today, we're seeing semiconductors as a whole kind of struggling. Here's SMH, which I sold out of my position here recently, so I'm feeling good that I did that. But we may see again some struggle for the semiconductor world, especially if we're seeing a bit of a risk-off rally continue. Semiconductors don't typically do well in that type of environment, so we'll continue to watch that close. Today's video is sponsored by DNA Funded, and if you're somebody looking to get funded this year, you can trade pretty much everything on DNA Funded. They also offer some pretty generous profit splits up to 90%, and they have unlimited trading days on their 1 to 2 different phase challenges that they offer on their site. Check them out down below in the description. There's a promo code A1T10 to get 10% off, and you can find out more information for yourself with the link in the description down below. Definitely check them out. Do your due diligence, see if they're right for you. The only winner yesterday, really, were the market makers for Nvidia, because, oh my goodness, in the options market, the premium that you have to pay to buy calls and puts on specific stocks can give you an idea of the options market expected move. And the expected move for Nvidia was like plus or minus 10%. So there was a forecast of 10% move in either direction on Nvidia's earnings. And what you can see today, guys, is when I say the market maker was the only winner, you can see the stock is up 2.35% in pre-market trading with just an hour to go. Now, why do I say the market maker was the winner in this scenario? Well, think about it. If you bought calls, the stock went up, right? So calls want the stock to go up, but it only went up 2%. So your option is going to be super worthless now, because now, the big catalyst is behind you and there's not likely going to be a move. If you bought puts on Nvidia, betting that the stock would drop on earnings, what happened? Well, it didn't drop. It actually went up and it didn't move very far. So the implied volatility, right? This is options 101, and I am an options trader, so I love to discuss this stuff. I know it's not the most popular stuff on my channel, but this is really actually quite important for just general trading knowledge. There was a big expected move for Nvidia. It didn't give you a big expected move in either ways. So the market makers who sold puts and sold calls on the event made the most money. And I got to pat myself on the back here because I sold both. I sold puts and calls. I sold a call at 150. So that call is going to be very worthless now, which is good for me because I shorted calls and I also shorted puts. I have 110 puts and 150 calls. So both of those, the 110s and the 150s options that I sold, I quote unquote played the market maker by shorting or selling those puts. Both of those are going to pretty much expire worthless almost certainly. And what that means is that if it expires worthless, it means that, again, I don't have to do anything as the option seller. I just get paid. I collect that premium as the market maker. People love to think market maker is some ominous term for somebody who is up in an ivory tower and trading against retail trading stop losses, and that is exactly not the case. The options market allows anybody to actually play market maker to an extent, because you can actually sell calls and sell puts to other traders, which is exactly what we did on Nvidia. So we had an earnings play on Nvidia. So Nvidia going nowhere is the perfect scenario for market makers. When you're selling options, you want stocks to not move at all. So just wanted to go through that. It's a kind of a fun concept. Earnings events, especially on stocks that I wouldn't mind owning shares in, are something that I like to play. And Nvidia, I had, like I said, I had 110 puts that I sold on the DeepSeek Monday. The big drop in the stock, I actually sold 110 puts. And with the market kind of, or the stock market itself kind of bouncing a little bit, but Nvidia specifically having a bounce from those lows, those puts are likely to expire worthless. At the same time, I sold the 150 calls, and those are also likely to expire worthless with little time to go. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.